All right, so you want to buy a golf course, or at the very least, you want to know what actually happens after you wire the money and take ownership. First of all, a modern championship golf course can cost anywhere from 5 million, 15 million, to even $50 million or more. That's more than most commercial real estate. It's more than the annual budget of some small towns. But here's the strange part. The company operating the golf course usually doesn't own it. And more importantly, how does owning a $50 million piece of land and grass actually make you money? Because in golf, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear golf course, they imagine manicured fairways and country club prestige. But a modern championship golf course is essentially a floating, self-sustaining industrial operation. It consists of hundreds of acres of specialized turf maintained by sophisticated irrigation systems designed to function in various climates without failing, and a fleet of heavy machinery capable of producing thousands of hours of maintenance work annually. It's all built for an expected operational life of 25 to 50 years. Take a large course ordered from a major designer like Tom Fasio, Jack Nicklaus, or Pete Dye, but the prices are not random. It all depends on the price of land at that time, the type of course you want to build, the climate you're building in, and the capacity of the region you want your course to be located in. And then there's global golf demand, the ultimate wild card. Golf course values don't behave like real estate, they behave like volatile stocks. When golf booms, then prices surge. During downturns, they collapse dramatically. For example, during the economic crisis of 2008, some golf course values dropped more than 40% in a single year. Courses that cost $30 million to build were suddenly worth $18 million before they even opened to the public, simply because demand had dropped. In golf course ownership, there are three main players: the developers, the course operators, and the course owners. And almost always they're completely separate companies. For example, a global operator like Troon Golf, Arcus Golf, or Club Corp operates thousands of courses. You see their logos on the clubhouse, but they do not own all of those courses. In fact, many operators prefer to own as few as possible. Many are simply managed under contract. So who holds the deed to that $50 million piece of land? It might be a wealthy family office. Families in certain regions control dozens of courses as multi-generational investments. It is a multi-generational art form of buying low and selling high. It could be a German investment fund where everyday citizens pool their money to buy a single golf course for tax benefits, or a Japanese leasing company, massive financial conglomerates that buy courses purely as depreciation assets on their balance sheets, or even a private equity firm operating out of a sleek office in New York or London. These owners don't care about the golf. They don't care about the logistics of maintaining fairways or hosting tournaments. They just rent their courses. Owning a golf course is basically a massive high-stakes leasing business. To make your money back, you have to lease it out. There are three main management models, each with a vastly different risk profile. Number one is the management contract. It is a relatively safe bet. The operator manages the course for a fixed annual fee, plus a percentage of revenue over a specific period. For example, $500,000 per year plus 10% of gross revenue for 10 years. Its owner provides the land, the course, and major capital improvements. The operator handles the daily operations, staffing, marketing, and customer service. If the course is popular when you sign, you lock in strong guaranteed returns. But if the market surges right after you sign, you're stuck at the old percentage. Number two is the lease arrangement. The operator leases the course for a fixed annual payment. They handle absolutely everything from hiring staff, managing budgets, maintaining the course, and running all operations. For the owner, this is lower income but almost zero involvement. Hand over the keys and wait for the annual check. Then comes number three. That is the equity partnership. The owner and operator share profits based on a predetermined split. Rates swing wildly based on current events, seasonal demand, or sudden economic crises. This is where owners make generational wealth. When golf boomed in the 1990s and early 2000s, courses that were generating modest returns suddenly became gold mines. Owners who had invested $10 million were suddenly seeing $2 million annual profits. Owners became millionaires in a matter of years. But the hangover is brutal. In 2023, as golf participation declined and courses consolidated, many of those profits fell by over 70%. How do these owners afford the courses in the first place? Because almost no one pays cash. The typical financial structure is 30% equity and 70% bank financing. Golf course banks provide colossal loans secured by the course itself. To protect themselves, owners use a legal shield called a special purpose vehicle. If a wealthy magnate owns 50 courses, they do not own them under one massive corporate umbrella. Instead, they create 50 separate shell companies, often registered in Delaware, the Cayman Islands, or other tax-friendly jurisdictions. One company, one course. Why? Because if a course faces environmental liability or goes hopelessly bankrupt, the rest of the portfolio is safe. But there's a massive problem lurking here. Let's say you borrow $35 million to buy a $50 million course. A year later, the market crashes and the resale value drops to 30 million. You're now underwater on your loan. The collateral is worth less than the debt. Bank panics and demands cash. If you can't pay, they seize the course. Golf course history is littered with the corpses of over-leveraged companies. Let's assume you manage the debt perfectly. You still face another enemy, regulations. A course physically lasts 25 to 50 years. But environmental rules are currently turning the industry upside down. The push to conserve water means sudden mandates for new irrigation systems, drought-resistant grasses, and massive water reclamation projects, costing millions per course. Furthermore, what happens if you build a course today in a region that becomes drought-stricken in 10 years? Your course becomes a stranded asset. It's too expensive to maintain, illegal to operate in certain seasons, and impossible to sell. Its $50 million drops to zero. Owners are constantly gambling on climate trends, water availability, and environmental regulations. Golf rewards patience and heavily punishes overconfidence. Because of this, courses are traded just like volatile commodities. A course bought for $50 million might be worth $60 million in a boom because buyers want a course today or drop to $30 million in a crash. Some owners don't even intend to operate the course for its full lifespan. They speculate, buy low, manage high, sell high, and when a course finally reaches the end of its useful life or becomes unprofitable, it still holds value. It is converted to other uses like residential development, commercial real estate, or simply abandoned. The owner is paid for the land value and any remaining assets. Even in decline, a large golf course might yield $20 to $30 million in land value, a final absolute floor to the asset's value. So why does this chaotic system work? For an operator like Troon Golf, owning every course in their portfolio is incredibly capital intensive and debt loaded. If golf participation slows down, an operator with 500 owned courses still has to pay 500 mortgages even if they're operating at a loss. Managing courses under contract provides flexibility. If demand drops, the operator simply lets their contracts expire and hands the courses back to the owners. The operator stays lean. The owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the courses don't disappear. The owners simply take them back and recontract them to a competitor. The companies may die, but the course keeps operating. Owning a $50 million golf course isn't just renting land. It means managing staggering debt, predicting macroeconomic cycles, betting on environmental regulations, and surviving brutal volatility. Operational costs of running a golf course are staggering and often underestimated by new owners. The single largest expense is maintenance and groundskeeping. A championship course requires a team of 30 to 50 full-time employees dedicated solely to maintaining the turf. These aren't just people with lawnmowers, they're specialized technicians managing soil chemistry, irrigation systems, pest control, and disease management. A head groundskeeper at a top course can earn $150,000 to $250,000 annually. Assistant groundskeepers earn $50,000 to $80,000. Irrigation specialists, equipment operators, and seasonal workers add another $500,000 to $1 million to the annual payroll. That's just the grounds crew. Then you have the clubhouse staff, pro shop managers, starters, rangers, food and beverage staff, administrative personnel, and security. A mid-sized course might employ 80 to 120 people total. The annual payroll can easily exceed $3 to $5 million. Equipment costs are another massive line item. Golf courses require specialized machinery, greens mowers, fairway mowers, rough mowers, aerators, top-dressing spreaders, and irrigation equipment. A single greens mower can cost $50,000 to $100,000. A course might have 10 to 15 of them. Equipment replacement and maintenance can run $200,000 to $500,000 annually. Water and irrigation is perhaps the most volatile cost. A championship course uses 40 to 60 million gallons of water annually. In regions with water restrictions, this can become prohibitively expensive. Water costs can range from $100,000 to $500,000 per year, depending on location and drought conditions. Some courses in California have seen water bills exceed $1 million annually. Chemicals for fertilizers, pesticides, and fungicides add another $100,000 to $300,000 per year. Insurance and liability coverage is substantial. A course needs general liability, property insurance, workers' compensation, and specialized golf course liability coverage. Annual insurance can cost $200,000 to $500,000 depending on the course's history and location. Property taxes are based on the land value and can be substantial. A 150-acre course valued at $50 million might face annual property taxes of $500,000 to $1 million depending on the jurisdiction. Utilities beyond water include electricity for clubhouse operations, heating, cooling, and lighting. This can add another $100,000 to $300,000 annually. Marketing and customer acquisition is essential for maintaining rounds played. A course might spend $200,000 to $500,000 annually on marketing, website maintenance, and promotional events. Food and beverage operations require inventory, staffing, and licensing. Even if outsourced, the course loses revenue to the operator. Repairs and capital improvements are ongoing. Bunker renovation, cart path resurfacing, clubhouse upgrades, and equipment replacement can cost $500,000 to $2 million annually, depending on the course's age and condition. When you add all these costs together, a typical championship course has annual operating expenses of $5 to $8 million. Some premium courses exceed $10 million annually. To break even, a course needs to generate significant revenue. A course with 40,000 rounds played annually at an average green fee of $150 generates $6 million in green fee revenue. To add cart rentals at $20 per round, that's another $800,000. Food and beverage might add another $1 to $2 million. Membership dues, if applicable, could add $1 to $3 million. Total revenue might reach $9 to $12 million. But this assumes full capacity and consistent demand. In reality, most courses operate at 60 to 75% capacity. A course generating $7 to $9 million in revenue against $5 to $8 million in expenses is barely profitable. The margin for error is razor thin. One bad season, one economic downturn, one drought, and the course becomes unprofitable. This is why so many golf courses have failed. The economics are brutal. The volatility of golf course values mirrors the shipping industry's unpredictability. During the golf boom of the 1990s and early 2000s, courses were built at a frantic pace. Developers couldn't build fast enough. Land values skyrocketed. A piece of land worth $1 million in 1990 might be worth $10 million by 2005. Courses that cost $20 million to build were suddenly worth $40 million. Owners who had invested modest amounts were sitting on massive paper gains. Private equity firms poured billions into golf course acquisitions. Consolidators like Troon Golf and Club Corp expanded aggressively. Everyone believed golf would grow forever. Then came 2008. Financial crisis hit and discretionary spending evaporated. Golf participation dropped 20% in a single year. Courses that were worth $40 million were suddenly worth $20 million. Owners who had borrowed $28 million to buy a $40 million course were now underwater. Banks seized courses, owners went bankrupt, courses closed. The industry contracted by 30%. Thousands of courses closed permanently. By 2010, the golf industry was in freefall. Courses that had been built for $30 million were being sold for $10 million. Some were simply abandoned. The land was too expensive to maintain, and nobody wanted to buy them. The recovery was slow from 2010 to 2015. Golf participation stabilized but didn't grow. Courses that survived did so by cutting costs aggressively. Maintenance budgets were slashed, staff was reduced, some courses became 9-hole operations, others converted to par 3 courses. The economics were brutal. Then came 2020 and the COVID-19 pandemic. Surprisingly, golf boomed. With people stuck at home and outdoor activities limited, golf became a refuge. Rounds played surged 20%. Courses that had been struggling suddenly became profitable. Owners who had weathered the 2008 crisis were vindicated. Private equity returned to golf with renewed interest. Courses that had been worth $15 million in 2019 were suddenly worth $25 million in 2021. Owners who had held on through the downturn made fortunes. But the boom was short-lived. By 2022 and 2023, as people returned to normal activities, golf participation declined again. Rounds played fell 10 to 15%. Courses that had been profitable in 2021 were struggling again by 2023. The volatility was stunning. A course could be worth $25 million one year and $18 million the next. This volatility makes golf course ownership incredibly risky. Unlike real estate, which tends to appreciate steadily, golf courses are subject to demand fluctuations. A course's value is directly tied to the number of rounds played and the price per round. If demand drops, value drops. If demand surges, value surges. This makes golf courses more like commodities than real estate. They're subject to boom and bust cycles. Owners who buy at the peak of a boom are often devastated when the bust comes. Owners who buy at the bottom of a bust can make fortunes when the boom returns. Timing is everything. This is why private equity has become so dominant in golf. Private equity firms have the capital to buy courses at the bottom of busts and hold them through the recovery. They can weather short-term losses because they're playing a long-term game. So they buy a course for $15 million in 2023, invest $2 million in improvements, and sell it for $30 million in 2027 when the market recovers. That's a 100% return on investment in 4 years. But this strategy only works if the market recovers. If golf participation continues to decline, those courses become stranded assets. The owner is stuck with a depreciating asset that generates insufficient cash flow to cover debt service. This is the nightmare scenario for golf course owners. A course that was supposed to be a cash-generating machine becomes a cash-draining liability. The owner is forced to either sell at a loss or default on the loan. Either way, they lose money. This is why golf course ownership is so risky. The economics are dependent on demand, which is volatile and unpredictable. A course that's profitable today might be unprofitable tomorrow. A course that's worth $50 million today might be worth $25 million in 5 years. Owners who don't understand this volatility are often blindsided by market downturns. They buy at the peak, borrow heavily, and then watch their investment collapse when demand drops. The graveyard of failed golf course owners is full of people who didn't understand the volatility. They thought golf was a stable, growing industry. They were wrong. Golf is a cyclical industry subject to boom and bust cycles. Owners who survive are those who understand this volatility and manage their debt accordingly. They buy conservatively, borrow modestly, and maintain strong cash reserves. They're prepared for downturns because they know they're coming. They're not surprised when demand drops because they expect it. This is the mindset required to succeed in golf course ownership. It's not a passive investment. It's an active, high-stakes game that requires constant attention and adjustment. Financing of golf course acquisitions follows a similar pattern to shipping. Most owners don't pay cash. The typical structure is 30% equity and 70% debt. A buyer with $15 million in equity might borrow $35 million to purchase a $50 million course. Loan is secured by the course itself. If the owner defaults, the lender seizes the course and sells it to recover the loan. This structure works fine when the course is profitable and the owner can service the debt, but it becomes catastrophic when the course becomes unprofitable. Let's walk through a scenario. An owner buys a course for $50 million. They put down $15 million in equity and borrow $35 million at 5% interest. The annual debt service is $1.75 million. This course generates $8 million in annual revenue and has $5 million in operating expenses. Net operating income is $3 million after debt service of $1.75 million. The owner has $1.25 million in cash flow. This is profitable. The owner is happy. But then the market crashes. Golf participation drops 20%. Revenue falls to $6.4 million. Operating expenses remain at $5 million because many costs are fixed. Net operating income drops to $1.4 million. After debt service of $1.75 million, the owner has a negative cash flow of $350,000. The owner is now losing money every year. If this continues for 3 years, the owner has lost $1 million. The owner's equity has been eroded. The owner is now underwater. The course is worth $35 million, but the owner owes $35 million. The owner has zero equity. If the market crashes further and the course is worth $30 million, the owner is underwater by $5 million. So the owner owes $35 million, but the course is only worth $30 million. The owner is in a terrible position. The owner can't sell because they'd have to pay $5 million out of pocket to cover the shortfall. The owner can't refinance because the course is underwater. The owner's only option is to default on the loan. The lender seizes the course and sells it for $30 million. The lender recovers $30 million, but is owed $35 million. The lender takes a $5 million loss. The owner loses their entire $15 million equity investment. This scenario has played out countless times in golf course history. Owners who borrowed too much and didn't maintain adequate reserves were wiped out when the market crashed. This is the mindset required to succeed in golf course ownership. It's not a passive investment. It's an active, high-stakes game that requires constant attention and adjustment. Its financing structure also includes special purpose vehicles. A wealthy owner with 50 courses doesn't own them all under one corporate umbrella. Instead, they create 50 separate shell companies. Each company owns one course. Why? Because if one course faces environmental liability or goes bankrupt, the other 49 courses are protected. The liability is contained to the single course. This is a critical risk management tool. If a course is sued for environmental contamination, the liability is limited to that course's assets. The other courses are safe. If a course goes bankrupt, the bankruptcy is limited to that course. The other courses continue to operate. This structure protects the owner's overall portfolio. It's a legal shield that separates risk. Without this structure, a single course's failure could bring down the entire portfolio. With this structure, each course is isolated. This is why sophisticated golf course owners use special purpose vehicles. It's not tax evasion, it's risk management. It's a way to protect the overall portfolio from the failure of individual courses. This structure is standard in the golf industry. Most large golf course owners use it. It's a best practice that protects owners from catastrophic losses. Regulatory environment for golf courses is becoming increasingly complex and restrictive. Environmental regulations are the biggest concern. Golf courses use massive amounts of water. In regions with water scarcity, this is becoming a major problem. California, Arizona, and other western states have implemented strict water restrictions. Some courses are limited to a certain amount of water per year. If they exceed the limit, they face fines or forced closure. This is a major threat to golf course viability in water-scarce regions. Some courses have been forced to convert to drought-resistant grasses or reduce the number of playable holes. Others have been forced to close entirely. Water restrictions are becoming more common as climate change intensifies droughts. This is a major risk factor for golf course owners in water-scarce regions. A course that was viable in 2010 might be unviable in 2030 due to water restrictions. Pesticide and chemical regulations are another concern. Golf courses use significant amounts of pesticides and fertilizers. Environmental regulations are becoming stricter about which chemicals can be used and how much can be applied. Some chemicals that were standard 20 years ago are now banned. Courses have to reformulate their maintenance programs to comply with new regulations. This increases costs and reduces effectiveness. Some courses struggle to maintain quality turf under the new restrictions. Labor regulations are another concern. Golf courses are labor-intensive operations. Minimum wage increases, overtime regulations, and worker classification rules all impact labor costs. Some states have implemented strict overtime rules that require courses to hire more workers or reduce hours. This increases costs. Some states have implemented strict minimum wage rules that significantly increase labor costs. A course in a state with a $15 minimum wage has much higher labor costs than a course in a state with a $7.25 minimum wage. This impacts profitability. Zoning and land use regulations are another concern. Some municipalities are restricting golf course development or requiring courses to meet certain environmental standards. Some municipalities are rezoning golf course land for residential or commercial development. This creates pressure to convert courses to other uses. Some owners see this as an opportunity. They can sell the land for residential development and make a fortune. Others see it as a threat. They want to keep the course operating but face pressure to convert. This creates tension between golf course preservation and development. Environmental liability is another major concern. If a course has contaminated soil or groundwater due to pesticide use, the owner is liable for cleanup. Cleanup costs can be millions of dollars. Some courses have been forced to close due to environmental contamination. The owner is liable for cleanup even if the contamination occurred decades ago under previous ownership. This is a major risk factor for golf course owners. A course that seems profitable might have hidden environmental liabilities that could cost millions to remediate. This is why environmental due diligence is so important when buying a course. A buyer needs to conduct thorough environmental testing to identify any contamination. If contamination is found, the buyer needs to factor cleanup costs into the purchase price. Some buyers have been blindsided by environmental liabilities that weren't disclosed. They bought a course thinking it was a good investment, only to discover millions of dollars in cleanup costs. This is a nightmare scenario for golf course owners. The regulatory environment is becoming increasingly hostile to golf courses. Water restrictions, chemical regulations, labor regulations, and environmental liability all create challenges for course operators. Courses that can't adapt to these regulations become unviable. Courses that can adapt survive. This is why regulatory compliance is so important for golf course owners. They need to stay ahead of regulatory changes and adapt their operations accordingly. Courses that ignore regulatory trends are often blindsided by new regulations that make their operations unviable. This is a major risk factor for golf course owners. The regulatory environment is constantly changing, and owners need to be prepared to adapt. The real estate dimension of golf course ownership adds another layer of complexity. Golf courses sit on valuable land. A 150-acre course in a desirable location might be worth $50 million, but the land itself might be worth $100 million if it were developed for residential or commercial use. This creates a constant temptation to sell the land for development. An owner who bought a course for $50 million might receive an offer of $100 million from a developer. The owner can sell the land, pay off the debt, and pocket $50 million in profit. This premium. Few owners can resist that temptation. This is why golf course preservation is so difficult. Financial incentive to convert courses to other uses is enormous. Courses that survive are those where the owner is willing to forego the development premium. This might be because the owner loves golf, or because the owner believes the course is a good long-term investment, or because the owner is part of a family that has owned the course for generations. But the financial incentive is always there to sell for development. This is a major threat to golf course viability. As land values increase, the temptation to convert courses to other uses increases. Some courses will inevitably be converted. Question is, how many? If too many courses are converted, the golf industry will shrink. If courses are preserved, the golf industry will survive. This is a critical issue for the golf industry. The real estate dimension of golf course ownership is a double-edged sword. It provides an exit strategy for owners who want to cash out, but it also creates pressure to convert courses to other uses. Courses that survive are those where the owner is willing to forego the development premium. This is a personal decision that each owner makes. But the financial incentive is always there to sell for development. The market dynamics of golf course ownership are complex and multifaceted. The industry is dominated by a few large operators who manage thousands of courses. Troon Golf manages over 500 courses worldwide. Club Corp manages over 150 courses in the United States. Arcus Golf manages over 200 courses. These consolidators have enormous scale and can negotiate favorable terms with suppliers and lenders. They can spread risk across hundreds of courses. If one course underperforms, the others compensate. This scale advantage is enormous. A small owner with one or two courses can't compete with these consolidators. A small owner has no scale advantage. If one course underperforms, the owner is in trouble. This is why consolidation has accelerated in the golf industry. Small owners are being bought out by large consolidators. The industry is becoming more concentrated. This concentration has both positive and negative effects. On the positive side, consolidators can invest in course improvements and technology that small owners can't afford. Consolidators can implement best practices across their portfolio. Consolidators can negotiate better terms with suppliers. On the negative side, consolidators are focused on maximizing returns. They're not focused on preserving golf courses or serving the golf community. They're focused on profit. This can lead to course closures if a course is underperforming. A consolidator might close a course that's losing money, even if the course is beloved by the local community. A small owner might keep the course open because they love golf or believe in the course's mission. A consolidator will close it because it's not profitable. This is the difference between small owners and large consolidators. Small owners are often motivated by passion for golf. Large consolidators are motivated by profit. This is why consolidation is controversial in the golf industry. Some people see it as necessary for the industry's survival. Others see it as a threat to golf course preservation. Reality is probably somewhere in between. Consolidation is necessary for the industry's survival, but it also threatens golf course preservation. The challenge is to balance these two concerns. The golf industry needs consolidators to invest in courses and improve operations. But the golf industry also needs small owners who are passionate about golf and willing to preserve courses even if they're not maximally profitable. This balance is difficult to achieve, but it's necessary for the golf industry's long-term health. The specialization problem is another major challenge for golf course owners. Golf course ownership is incredibly specialized. It requires knowledge of turf management, irrigation systems, golf course design, golf industry trends, and golf course operations. A general real estate investor who buys a golf course without this specialized knowledge is at a major disadvantage. They don't understand the operational challenges. They don't understand the regulatory environment. They don't understand the market dynamics. They're flying blind. This is why many golf course acquisitions by non-golf investors have failed. They bought courses thinking they were just real estate investments. They didn't understand the specialized nature of golf course operations. So they made operational mistakes that destroyed profitability. They lost money and eventually sold the courses at a loss. This is a common pattern in golf course history. Non-golf investors buy courses, make mistakes, and lose money. Golf industry veterans buy courses, apply their knowledge, and succeed. This is why golf course ownership is best left to people with golf industry experience. A buyer without this experience is at a major disadvantage. They need to hire experienced operators to run the course, but this adds costs and reduces the owner's control. This is why many golf courses are owned by people with golf industry experience. They understand the business, they know how to operate a course profitably, they know how to navigate the regulatory environment, they know how to manage the market cycles. This specialized knowledge is invaluable. A buyer without this knowledge is at a major disadvantage. This is why golf course ownership is not a good investment for general real estate investors. It's a specialized business that requires specialized knowledge. Buyers without this knowledge should avoid golf course ownership. They're likely to lose money. This is a critical lesson for potential golf course buyers. Golf course ownership is not a passive investment. It's an active, specialized business that requires deep knowledge of the golf industry. Buyers without this knowledge should avoid golf course ownership. They're likely to lose money. This is a major barrier to entry for golf course ownership. It's not enough to have capital. You also need specialized knowledge. This is why golf course ownership is concentrated among people with golf industry experience. They have the knowledge required to succeed. General investors without this knowledge are at a major disadvantage. The illiquidity of golf courses is another major challenge for owners. Unlike stocks or bonds, which can be sold in minutes, golf courses take months or years to sell. A buyer needs to conduct extensive due diligence. They need to review financial statements, operational data, and environmental reports. They need to visit the course multiple times. They need to negotiate terms. The process is slow and expensive. This illiquidity creates problems for owners who need to sell quickly. If an owner needs cash, they can't just sell the course. They have to wait months or years for a buyer to emerge. If they need to sell quickly, they have to accept a lower price. This illiquidity is a major disadvantage compared to other investments. A stock investor can sell in minutes. A golf course owner might wait a year to find a buyer. This illiquidity also makes it difficult to exit a bad investment. If an owner realizes they made a mistake buying a course, they can't just sell it. They have to wait for a buyer to emerge. In the meantime, they're losing money. This is a major disadvantage of golf course ownership. The illiquidity creates problems for owners who need to sell quickly or exit bad investments. This is why golf course ownership is best suited for long-term investors who don't need to sell quickly. Short-term investors should avoid golf courses because of the illiquidity. This is a critical lesson for potential golf course buyers. Golf course ownership is illiquid. Owners need to be prepared to hold the course for many years. If they need to sell quickly, they'll have to accept a lower price. This illiquidity is a major disadvantage of golf course ownership. Buyers should understand this before investing. Golf course ownership is not a liquid investment. It's a long-term illiquid investment that requires patience and capital. Buyers without patience and capital should avoid golf course ownership. They're likely to lose money if they need to sell quickly. The case studies of failed golf course owners provide valuable lessons. During the 2008 financial crisis, thousands of golf courses went bankrupt. Owners who had borrowed heavily to buy courses at the peak of the boom were wiped out when the market crashed. A course that was worth $40 million in 2007 was worth $20 million in 2009. Golf course acquisitions. They believed golf would grow forever. They bought courses at high prices and borrowed heavily. When the market crashed in 2008, many of these private equity investments were wiped out. Private equity firms lost billions. Some private equity firms exited the golf industry entirely. Others stayed and learned from their mistakes. They became more conservative in their acquisitions. They borrowed less. They maintained stronger cash reserves. They were better prepared for downturns. This is a critical lesson. Private equity firms that survived the 2008 crisis learned to be more conservative. They understood that golf is a cyclical industry. They understood that downturns are inevitable. They prepared for downturns by maintaining strong cash reserves and conservative leverage. This is why some private equity firms have succeeded in golf while others have failed. The successful ones learned from the 2008 crisis. The unsuccessful ones didn't. Another case study is the consolidation of the golf industry. Over the past 20 years, the golf industry has consolidated dramatically. Small independent courses have been bought out by large consolidators. The number of independent courses has declined significantly. This consolidation has been driven by economics. Large consolidators have scale advantages that small owners can't match. Large consolidators can negotiate better terms with suppliers. Large consolidators can spread risk across hundreds of courses. Small owners can't compete. This consolidation has had both positive and negative effects. On the positive side, consolidators have invested in course improvements and technology. On the negative side, consolidators have closed underperforming courses. Some beloved courses have been closed because they weren't profitable enough for the consolidator. This is a tragedy for the golf community, but it's a reality of consolidation. Consolidators are focused on profit, not preservation. This is why consolidation is controversial in the golf industry. Some people see it as necessary for the industry's survival. Others see it as a threat to golf course preservation. Reality is probably somewhere in between. Consolidation is necessary for the industry's survival, but it also threatens golf course preservation. The challenge is to balance these two concerns. Another case study is the impact of changing demographics on golf courses. Golf participation has declined over the past 20 years. Younger people are not taking up golf at the same rate as older generations. This has created a demographic crisis for the golf industry. Courses that were built for a growing market are now facing a shrinking market. Some courses have closed because they can't attract enough players. Others have converted to par 3 courses or 9-hole courses to reduce operating costs. This demographic shift is a major threat to golf course viability. Courses that can't adapt to changing demographics will fail. Courses that can adapt will survive. This is a critical lesson for golf course owners. They need to understand demographic trends and adapt their operations accordingly. Courses that ignore demographic trends are likely to fail. This is a major challenge for the golf industry. The demographic trends are not favorable. Younger people are not taking up golf. This means the golf industry will shrink unless it can attract new players. So this is a critical challenge for the golf industry. Courses that can attract new players will survive. Courses that can't will fail. This is a major threat to golf course viability. The golf industry needs to address this demographic challenge or face continued decline. The end game for golf courses is often conversion to other uses. When a course reaches the end of its useful life or becomes unprofitable, the owner faces a choice: keep operating the course at a loss or convert it to another use. Most owners choose conversion. A course that's worth $50 million as a golf course might be worth $100 million as residential land. The owner can sell the land to a developer, pay off the debt, and pocket the profit. This is an enormous incentive. Most owners choose conversion. The land is converted to residential developments, commercial real estate, or other uses. The golf course disappears. This is why so many golf courses have closed over the past 20 years. The land is worth more for other uses than for golf. From a financial perspective, this makes sense. An owner who can sell land for $100 million instead of operating a course that generates $3 million in annual profit is making a rational financial decision. But from a golf perspective, this is a tragedy. Courses that have been operating for decades are closed and converted to housing. The golf community loses a course, but the owner makes a fortune. This is the fundamental tension in golf course ownership. It is worth more for other uses than for golf. This creates constant pressure to convert courses to other uses. Some owners resist this pressure because they love golf or believe in the course's mission. Others embrace it because they want to maximize their financial returns. This is a personal decision that each owner makes, but the financial incentive is always there. A course that's worth $50 million as a golf course might be worth $100 million as residential land. That's a 100% premium. Few owners can resist that temptation. This is why golf course preservation is so difficult. Financial incentive to convert courses to other uses is enormous. Courses that survive are those where the owner is willing to forego the development premium. This might be because the owner loves golf, or because the owner believes the course is a good long-term investment, or because the owner is part of a family that has owned the course for generations. But the financial incentive is always there to sell for development. This is a major threat to golf course viability. As land values increase, the temptation to convert courses to other uses increases. Some courses will inevitably be converted. The question is how many. If too many courses are converted, the golf industry will shrink. If courses are preserved, the golf industry will survive. This is a critical issue for the golf industry. In conclusion, owning a golf course is not a passive investment. It's an active, high-stakes game that requires constant attention and adjustment. It means managing staggering debt, predicting macroeconomic cycles, betting on environmental regulations, and surviving brutal volatility. Separation of ownership and operation spreads risk across the golf industry. When an operator goes bankrupt, the courses don't disappear. The owners simply take them back and recontract them to a competitor. The companies may die, but the course keeps operating. This separation of ownership and operation is a critical feature of the golf industry. It allows the industry to survive operator bankruptcies. It allows courses to continue operating even when operators fail. This is why the separation of ownership and operation is so important. It's a risk management tool that protects the golf industry from catastrophic failures. When you multiply golf course ownership across dozens of courses, leveraging debt and reading the tides of golf demand, you begin to understand how modern golf empires are built, not through control of the game, but through the relentless calculation of risk. Golf course ownership is fundamentally about risk management. Owners who understand risk and manage it carefully succeed. Owners who don't understand risk or manage it poorly fail. This is the fundamental lesson of golf course ownership. It's a high-stakes game that rewards careful risk management and punishes carelessness. The future of golf course ownership is uncertain. The golf industry is facing demographic challenges, environmental challenges, and financial challenges. Courses that can adapt to these challenges will survive. Courses that can't will fail. The golf industry will shrink unless it can address these challenges. But for owners who understand the risks and manage them carefully, golf course ownership can be a profitable and rewarding investment. It's not for everyone. It requires specialized knowledge, significant capital, and the ability to manage risk. But for those who have these qualities, golf course ownership can be a path to building wealth and creating a lasting legacy. The golf industry will continue to evolve, consolidation will continue, courses will continue to close, but golf will survive. And for owners who understand the economics of golf course ownership, there will continue to be opportunities to build wealth and create value. The key is understanding the risks, managing them carefully, and having the patience to weather the inevitable downturns. Golf course ownership is a long-term game. It rewards patience and punishes impatience. It rewards careful risk management and punishes carelessness. It rewards specialized knowledge and punishes ignorance. For those who have these qualities, golf course ownership can be a path to building wealth and creating a lasting legacy. For those who don't, it's a path to financial ruin. The choice is yours. But understand the risks before you invest. Golf course ownership is not a passive investment. It's an active high-stakes game that requires constant attention and adjustment. It's not for everyone, but for those who understand the risks and have the skills to manage them, it can be a rewarding and profitable investment. The future of golf course ownership is uncertain. But for those who understand the economics and manage the risks carefully, there will continue to be opportunities to build wealth and create value in the golf industry. If you found this analysis valuable, please like this video, subscribe to the channel for more deep dives into economics and complex industries, and leave a comment sharing your thoughts on golf course ownership and the challenges facing the industry today.